And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, as we get ready to wrap up the last week of June, it's also the last week of the quarter, which means a whole lot of stuff going on. Friday, of course, was a big triple witching options expiration Friday. That's a lot to get out at one time. Basically a lot. There was $5.1 trillion worth of options that expired on Friday. So a bit of volatility on Thursday and Friday, particularly with the most loved stock. Nvidia had a bit of a drawdown over the last couple of days. And again, that's just has a lot to do with the options expiration. There was a lot of headlines talking about, is the run over for Nvidia? Probably not yet. We're still in the midst of all that hype. But again, because of all that options expiration, not surprising you saw a little bit of selling in the stock Thursday and Friday as those options were either getting ready to mature. People that were long options or short options had to rebalance. And again, the options makers, had to buy or sell the stock according to the options demand. So anyway, that's what happened on Thursday and Friday of last week. Not a big deal. The one thing we kind of keep focusing on, keep talking about, of course, is breadth of the market. We're going to talk about that this morning. That's also the subject of this past weekend's newsletter. So a lot of these charts we'll go through today with you, talking about breadth in different forms. Are all in the weekend newsletter. So if you haven't subscribed to the newsletter, simply go to the website, realinvestmentadvice.com. It's the Bull Bear Report. Just enter your email address. We'll email it to you every Saturday. Not only do we do a kind of a full commentary about a market or whatever's going on that's important, also lots of market statistics, stats, stock screens, things to help give you some ideas about where to start looking in your portfolio for opportunities or maybe where the risk is. And we go through a lot of that data every Saturday. That's, of course, on the website, realinvestmentadvice.com. So just put your email address in. It's absolutely free. We email it to you every Saturday. So a couple other things going on right now. Friday, Thursday and Friday, we had some interesting data points coming out. The S&P Global Manufacturing and Services Index both showed a fairly sharp uptick, suggesting that, the economy's doing okay. They're in expansion right now. Everything's fine. So that was good data from that front. Employment was increasing. Now, again, these are kind of run and, really don't jive with a lot of each other. We'll see if the ISM Services and Manufacturing agree with S&P Global. A lot of times they have different opinions because of how they collect their data. But at the same time, the leading economic index. Now, this is the leading economic index is produced by the Conference Board and has multiple indicators inside of it talking about, what is going to happen in the economy in the future. So this index tends to lead economic expansions and contractions. Here's the interesting thing. That index has now been negative for 27 months in a row. That is the longest stretch of a negative print for the LEI index on record. One of the best indicators of a recession has been the 6-month rate of change in that index. So you take a look at what the rate of the level of the LEI index over the last 6 months. Look at that rate of change each month, and when that 6-month rate of change goes negative, that has typically preceded a recession. That has also been in very negative territory for a very long time now. And yet there's been no recession. So this is really going to be an interesting one for the record books when we go back in the future and look back at this period. And again, we don't know what we don't know yet, which is all the data revisions that are coming in. California, the Labor Board of California just came out with analysis for 2023, basically showed no employment growth in California in 2023. It was a net job growth of 9,000 jobs for the entire year. So that really kind of belies a lot of this economic data that we're getting that suggests the economy is roaring along and we're all doing great. A lot of the other data certainly doesn't support it, but the leading economic index has been telling us that the economy is much weaker than we may think it is for the last 27 months. And that leading rate of that 6-month leading rate of change is has a perfect track record of predicting recessions until now. Same thing with the inverted yield curve. The inverted yield curve has a perfect track record of predicting recessions until now. So again, we'll see what happens. The view is right now is that there's absolutely no risk of a recession on the horizon. Could it just be very delayed because of all the monetary interventions and stimulus acts and CHIPS Act and Inflation Reduction Act, all this money we've been shoving into the economy could have just delayed the recession. Will these indicators eventually turn out to be correct? We'll see. Typically, by the time the Fed starts hiking rates, a recession takes about 2 years to show up. We're in that range. So we'll see what happens. But again, very, very long stretch of these indicators being negative. Okay, having said that, let's talk a little bit about Friday. Here's what you need to know before the bell. As I said, on Friday, markets were a bit weak on Friday, traded sloppily most of the day. Not a big down day by any stretch of the imagination, but that was all that options expiration that was going on. Not surprising, we saw a bit of volatility. As we talked about on Wednesday, the markets had gotten very, very overbought, and the market was due for a bit of correction. And we saw that on Thursday and Friday. Had a bit of a sell-off on Thursday, a little bit more on Friday, sloppy trading on Friday. It started to reverse some of that overbought condition. Again, not a tremendous amount. Now, this is in particular the technology sector that we're taking a look here. But again, if we take this and look at the S&P 500, you can't really tell much of a difference because pretty much technology has been driving the S&P. In fact, it's one of the largest. It's the largest sector in the S&P. It's got most of the heaviest weighted names in the S&P are technology stocks. So pretty much you can overlay both of these indexes and they look just alike. But again, same thing here. Even on the S&P itself, seeing a bit of a sell-off. NVIDIA, of course, was everybody's big concern over the weekend. As I said, is that they sold off for a couple of days. Had decent sell-offs, 3-4% over the last couple of days of the week. And had a lot of people concerned like, is the peak of NVIDIA? And probably not. Had a lot to do with that options expiration. But again, markets are overbought. We are due for a bit of correction here, at least consolidation, to help bring these moving averages up to the markets, or eventually the price has to correct back to these moving averages. These deviations, as we talked about previously, are getting pretty decently extended. Again, a good time here to take some profits, rebalance risk, add some hedges to your portfolio if you want. There's a lot of optimism in the markets right now, and that's certainly not surprising because of this action that we've had here really since that correctional process that we had back in April. People have gotten very, very excited about the market. Allocations are reaching some of their highest levels on records for retail investors. Again, just very, very optimistic about the markets. That's typically a good time to be a little bit more risk averse. Remember, one of the bases of contrarian investing is when everybody's on one side of the boat, you kind of want to be on the other. Not entirely, right? You don't want to be shorting the entire market, but being a little bit more cautious when everybody is very, very excited about the markets and potential upside. Now we're seeing, all these upgrades to year-end estimates. Goldman Sachs 6,300 by the end of this year, right? We're at 5,400 right now. So Goldman's expecting this market to rally to 6,300 by the end of this year. I'm not saying that can't happen, but this is typically what happens. We came into this year with targets for the year end around 4,800 to 5,000. Now these are all getting ratcheted up to 6,000 to 6,300 because of this market advance. Again, everybody's very excited. This is very similar to what we saw last year in June, halfway into July. Markets were rallying, and then we had that 10% correction between July and September. So again, a very similar market environment to just almost kind of replaying last year. We'll see what happens this summer. But again, a little bit of risk management here certainly would be advised. All right, that's what you need to know before the bell this morning. When we come back from the break, we'll get into market breadth. Just how bad is it? I'll let you know. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So a couple of things here as kind of just talk about the markets, a little bit of risk management, things that are going on. And again, we're just seeing a lot of similarities currently kind of play out in the market that we've seen previously. And this is a subject we covered in a bit more detail in this past weekend's newsletter. But one thing that I talked about kind of specifically is that investors make two mistakes when we start talking about risk management, right? And so, I published this chart. I'm going to go a little bit more detail into some of the numbers here in a second, but I kind of just pointed out that there's been a negative divergence showing up in the markets on a variety of levels, relative strength, MACDs, et cetera. And, historically, when we have these kinds of negative divergences, bad breath, a lot of optimism in the market, this is where we start talking about risk management. And, this, as I just said a second ago, maybe this is the time to start thinking about taking some profits, rebalancing risk, et cetera, if you haven't done so already. And this is the reason but this is also the point to where investors tend to make two primary mistakes, which is they act too soon and they overreact. And again, the problem with technical analysis is that it doesn't work on a dime, right? Just because you're overbought doesn't mean you can't stay overbought for a while longer. Just because you have negative divergences doesn't mean the market can't keep going up for longer than you expect. And so what happens is a lot of investors tend to, first of all, as soon as there's an indication, right? Markets are overbought. All right, I'm going to sell all my stocks and get out of the markets, right? Because the market's going to correct. And then the market can stay overbought for a long time. And second thing is they overreact. And so they tend to go extreme. Market's overbought, I'm going to sell everything, right? I'm going to short the market at the same time. So they tend to go 180 degrees in the other direction, expecting this big correction to happen. They're going to make a lot of money, et cetera. But that doesn't happen. And then what happens is the market keeps kind of grinding its way higher. and then eventually go, well, I'm missing out now. I've got to get back in. So one of the, and this kind of brings us to, back in February. So on February the 10th, I wrote an article and I posted this chart on February the 10th. And in that article, I said, that unstoppable advance by the mega cap stocks on Friday. Again, this is Friday, February the 10th, or February the 9th then, because this was published on a Saturday. Topped the psychological level of 5,000. With strong momentum carrying the particular group of stocks, the index will likely try to push higher over the next few days. However, it's shown the market's back to more extreme overbought levels, and bullish sentiment has reached greed fears. Most notably, the deviation between the index and the 200-day moving average is getting rather extreme, which has typically preceded short-term corrections. We are highly confident that a correction is coming. The timing of that event is uncertain. As such, we maintain exposure to garner performance while we can. However, we will become more aggressive to reduce risk once signals are triggered. So that was the chart back in February. So again, very similar to kind of the setup we've got right now. But the problem is that the correction didn't come until April. So but it took until April to finally get those signals to reduce risk. And so in March, we actually started reducing risk some because we started seeing some early signals of deterioration. And then heading into April, we reduced some risk some more. But again, it took time for us to get to that point to where we had that correction. Again, and this is the chart that kind of shows that is, that first blue line is where we published that article on February the 10th. The market just kept grinding higher. And so, and again, you'll notice relative strength index was declining while the market was rallying. You had that negative divergence going on. The MACD sell signals, they were flipping back and forth. They didn't give you a good sell signal. And then finally you got a good sell signal in April. And then we had that correction through April. So again, this is the problem with investors, is that they often tend to kind of overreact to things and they wind up getting sucked back in just at the time that the correction is not going to happen. I got to get back in. And that's about the time the correction normally happens. So again, this is why you have to kind of manage risk a bit along the way. But again, back to the breadth. We are back to seeing some of those very same measures that we saw back in February and early March, suggesting that a correction was going to be likely. Of course, that was, again, the markets can just kind of keep grinding higher here because of exuberance, et cetera. And again, if we take a look at the markets, take a look at the number of stocks trading above their 200-day moving average and their 50-day moving averages, those are declining. Even though the markets are making new highs, stocks above, the number of stocks, even in the NASDAQ 100, right? More stocks are making 52-week lows than making 52-week highs. And that shouldn't be the case, but that kind of shaded area behind the graph of the S&P 500, that big spike in green, that's money flows coming into the markets. So you've got this big surge in capital chasing the markets ever since that April correction that is driving this market substantially higher, even though it's in a relatively few number of stocks, right? Because the number of stocks above their 15-200-day moving averages are going down, which means there's a lot of stocks that are selling off and fewer stocks actually pushing the index to all-time highs. Again, that can last a lot longer than you would expect, but it is just a function of the markets. And again, if we take a look at kind of this complacency in the overall market, it's been a very long time now. It's been over 333 days since the market has had a 2% decline in the S&P 500. So, again, there's longer periods. I mean, we've gone long periods. The record was back in 2004-05. We went almost 950 days without a 2% correction. So complacent markets can last a long time, but we're pushing kind of the limits, going back throughout history of where we don't have a 2% decline day. And, you're going to wake up one day, the market's going to be down 2%. You're like, what happened? And basically it'll just be an unwinding of some of this excess, right? Just we talked about before is that the markets are like two rooms, right? In one room, you've got all your buyers. One room, you've got all your sellers. Or right now, everybody's in the buyer's room. Everybody's buying. And they're having to drag the sellers, whoever wants to sell or really doesn't want to sell, they're finally just offering them prices like, man, I got to sell something. Prices are too good. So they're just dragging these sellers into the market. So the problem with that is that some morning we're going to wake up and everybody's going to be in the seller's room all of a sudden. And the problem is there's going to be no buyers. And as we've talked about before, we've written about this in our newsletter, we talked about it on the show, is that, buyers live higher, sellers live lower. And sellers live higher, buyers live lower. I'll get that right here in a second. But what that means is that one morning you're going to wake up and the market's going to be down sharply for some piece of news, whatever it is, because buyers are saying, okay, yeah, I'll buy the shares from you, but it's going to be at a much lower price. And that's how you get these big sharp corrections in the markets on a given day, because simply buyers are willing to buy, but they're substantially lower in the market price than where the price was trading yesterday. So that's why that'll happen. But again, this is why you want to take some actions in advance, right? Trim a little hair, hedge a little bit here, whatever it is, just to help offset that. And again, as I was talking about earlier, everybody's extremely bullish. You take a look at the retail investor allocations from the American Association of Individual Investors, their equity allocations are reaching previous peaks. Cash levels are continuing to decline. So the average retail investor is fully allocated back into equities. They've been trimming their bond exposure, trimming cash hedges, and getting back into the market. So it's like, yeah, I can get 5% in money market, but I'm making 15% in the market. Why would I be in money market when I'm making 15% in the market year to date? And so this is that kind of exuberance. At the same time, volatility index dropping, complacency is very, very high. So you've got near record allocations of investors. You've got record high levels of complacency and extremely low volatility in the markets. And of course, low volatility tends to always beget higher volatility. We can combine those two, right? So if we know that that investor sentiment is elevated and that's high and volatility is low, we can combine those two together into an index. And we get a composite that is also ringing out towards one of its higher levels on record. Typically, when you get readings this elevated in that index of and this is just a pure measure of investor complacency, you're typically near. Now, again, not always. It's not a good timing indicator. It doesn't mean, hey, today we're at this level, get out of the market, right? But typically when you're getting this elevated, you're typically near at least a short-term period of consolidation or correction. So again, just complacency, the negative divergences, all these type of things in the market just simply suggest that we've come a long way since April. We had that correction in April, reversed a lot of that. Big rally here, that's great. Now it can last longer. I mean, we could get into June, July, maybe even into August. But at some point, what all this data is telling you is that managing some risk here is likely going to pay off for you because we're going to get a correction. It's coming. It's just a matter of time. And unfortunately, the timing of that is the most difficult part. Okay, quick break. We'll come back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The bets are on right now for the NVIDIA drinking game.
The Real Investment Show podcast.
Every time NVIDIA says the word AI, you have to take a shot.
Same show, your schedule.
By the time they get through the earnings call, half the country will be completely obliterated and it really won't matter what they say their earnings were, which will be just in time for the debates. Exactly.
At realinvestmentadvice.com.
That's a whole other drinking game right there.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
You know, talking a little bit about breadth, one of the interesting divergences this year has been the break between the S&P 500 market cap weighted index and the equal weighted index. So there's two ETFs that track these. SPY is the ETF that tracks the S&P 500. There's lots of these, but just two simple ones. RSP is the ETF that tracks the equal weighted index. And it's a little bit of a misnomer when you talk about equal weighting versus market cap weighting. So market cap weighting is fairly, you would think is fairly straightforward, and it is actually. You go, well, if, Apple is in the index and, its market capitalization, which is price times the number of shares outstanding, equals, $3 billion, then, it's at the top of the list because it's larger than most every other company in the index. Last week, for a brief moment, NVIDIA was the largest market cap weighted stock on the planet. It actually exceeded Microsoft, which is slightly larger than Apple. So that's fairly straightforward. The equal weighted, now you would think from the title, right, that the equal weighted index just means the exact same stocks, they just all have an equal weight. And there's some truth to that, but it's not really that way. Right, and we're going to go into that in a second, but there's a reason why this divergence in performance has been so marked over the course of the last couple of years. In fact, this chart is of SPY versus RSP going back to 2022. The bottom of the market was in October. And so starting in kind of December to now, those two indexes were tracking fairly close together. And then you see this big divergence starting to show up in 23 and in 24. And in fact, that divergence is the S&P is ahead of RSP by about 2-to-1 right now. So just a very big gap in performance. Now, the thing is let's take a look at the holdings of SPY, and this will explain why there's this big divergence in performance. So if you take a look at SPY, the top 10 holdings are Microsoft, Apple, NVIDIA, both coming in at about 6% each. Then Amazon, Meta, Google, Berkshire Hathaway, Eli Lilly, and JP Morgan. As you see, 31.5% of the index is technology. So again, not surprising that with Microsoft, Apple, NVIDIA, Amazon, Meta, Google all leading the way, and 31% of that index is made up of those stocks, not surprisingly, the S&P has been performing very well because those stocks have been performing very well. Now, financial services make up 12%, healthcare is 12%, and then consumer cyclical is 10%. Consumer cyclical is discretionary, so that's like Amazon. Now, interestingly though, let's take a look at RSP. And you'll start to understand why there's such a difference in performance. So first of all, if we take a look at the sector weightings, technology only makes up 15%. So it's only got half the weighting in technology that the S&P does. But importantly, look at the top 10 holdings. First Solar, NextEra, Moderna, Vistra Corp, NRG, Teradyne, AES Corporation, Freeport-McMoRan, Micron Technology, Constellation Energy. Also take a look at the weights. They are all 0.3%, 0.2% of the index. So right now, you can already see, right, in the top 10 holdings, no Apple, no Google, no Microsoft, no NVIDIA. Those stocks are in there, but they're down on the list. Industrials make up 14% of the index. Industrials have been doing well, by the way, so that's been helping. Financial services, healthcare, consumer cyclical. So the weightings are representative, right? But they're smaller than, and particularly in technology, than what we saw in the S&P. So that explains right up front that if you're long an equal weight index, why your performance is so poor relative to the SPY because of the market cap weightings and what stocks are participating the most in that performance. And again, this is the interesting thing. If we take a look at the two, but now when we talk about this, right, it's like, okay, well, when's that going to change? Right? And that's a good question. We take a look at, we just looked at 2 years, right? So December 22 through present, so that was 2 years roughly. So if we take a look at the 2-year performance spread between the market cap and equal weight index, we're at the highest level of that deviation in performance going back to the pandemic and then going back to the financial crisis. Now, again, what's important is that when you've had these previous peaks, there was a reversion in that performance. In other words, RSP played catch up. Now, again, you got to be careful, right? This is just what we were talking about a second ago. Well, Lance said there's going to be this reversion in RSP to SPY, so I'm going to sell SPY and go buy RSP. Be careful, right? What's the two mistakes that we make? We act too early. We overreact. We do too much. I'm not telling you to make that change. What I'm telling you is that this is an interesting thing to be paying attention to because of that negative breadth. This is another representation of that negative breadth that we were talking about. There's a lot of stocks simply not performing in the markets, and that's driving a big chunk of this underperformance. Also has to do to weightings, et cetera. This is also a really good thing to look at in terms of your own portfolio. It is probable that your portfolio does not look like the SPY. In other words, you don't have 31% of your portfolio in basically 5 stocks. You may. Most people don't. most people are still kind of hanging on to this diversification theory of owning mid-cap, small-cap, international emerging markets and diversified portfolio. That's not working because of the concentration of flows into the markets right now and where they're going to. So for most people are underperforming the S&P 500 this year because they simply don't have enough weight in those stocks. This is also the problem we talked about last week with portfolio managers who are forced to chase these stocks, right? We talked about career risk. And that career risk is if I don't have performance, I lose clients, I lose customers, I lose investors. And so that career chase is fueling this dislocation in the markets. And there's a risk to that. Eventually that will reverse. Now, what causes it to reverse, simply don't know. And nobody ever does. But eventually something happens and you get a reversal in that performance for whatever reason. So just something to kind of pay attention to. But again, things are changing, and we've got a different environment right now. Tremendous amount of foreign inflows into the U.S. This is why the dollar is getting stronger. We have a lot of foreign money flowing into the U.S. to go into the financial markets here. Some record inflows. That's making the dollar stronger, and that's why with the dollar getting stronger, you're seeing countries like China, et cetera, buying gold for their central bank to help balance off the currency risk. They're selling treasuries to balance off the currency risk. You're seeing that. That will change at some point, and those money flows into the U.S. will leave for whatever reason. Stock buybacks, et cetera, have all been fueling this. So, again, just you want to be careful here, and this is where we talked about before, managing some risk, doing some basic gardening, right? Take some profits. If you, for instance, a good example, we sold NVIDIA earlier this year, right before they announced earnings. We sold NVIDIA back down to target. So our target weight for NVIDIA in our portfolio is 2%, not 6%, right? Risk management. So we have a 2% position. So we sold it back down. We were almost at 3% because of the growth in the stock. We sold it back down to 2% going into earnings, not knowing what they were going to announce. And since then, we're now back up to 3% weight in NVIDIA. So we're going to at some point here trim that back down towards 2%. Just take profits. If the thing does correct, then we'll add, more money to it at some point, right? Because we like the long-term trend, right? We like the fundamentals, those type of things. Company's in the right spot right now. So, we have to keep managing that position. But that's, so think about doing that kind of cleanup in your portfolio, just doing some basic kind of maintenance to the portfolio. Again, this market rally could continue longer, well into July, but at some point it's going to correct. And if you do kind of some of the maintenance work now, when that correction does occur, you won't be in such a panic to try to figure out what to do when you're in the midst of the correction. In the middle of the correction, that's when we tend to make our biggest mistakes because we overreact. We assume that the correction is going to be bigger than it actually is going to be. We start making all these other assumptions. Headlines get really, really bearish all of a sudden, so we start overreacting emotionally. But if you do some of that work ahead of time, yes, you're going to miss some upside, right? You're not going to grow as fast as the market, right? That's okay, though, because when you have that correction and it eventually occurs, you won't be in such a panic to try to take action because you've already done the work and your portfolio will be shielded from that decline. Okay, quick break. We'll come back. Ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, let's get ready to wrap up the show this morning. Futures are flattish this morning, not a lot going on. Dallas Fed manufacturing out this morning. Again, we were talking earlier about S&P Global. Just came in with manufacturing and services both upticking into expansion territory. So again, those indexes are showing a very different picture than ISM manufacturing. Also, the individual regional Fed surveys, Dallas, Philadelphia, et cetera, certainly show a very different picture than S&P Global. So again, this is the problem with a lot of this economic data. It depends on how it's calculated, who calculates it, how they weight it, how they measure it. They can come up with very different, outcomes. So we have to pay attention to all this data to try to parse through it all and come up with what's a reasonable expectation for economic activity, growth, kind of which direction we're headed. And that just makes it a bit more challenging when you have this kind of diversity of information. And then also, again, as we talked about before, with surveys like S&P Global, like Dallas Fed, et cetera, it can show an uptick in sentiment. These are very much sentiment surveys. They're not asking, for instance, the Dallas Fed survey, which will be out today, manufacturing survey out today. They don't ask them, okay, how many units did you sell last month versus how many units did you sell this month? And then measuring production that way. It's a question of, are you selling more stuff? Are you thinking about hiring more? Are you putting more employees to work? Are you these type of questions? So if they go, well, how was sales this month? They were a lot better than last month. Okay, but what does that mean? If sales were 0 last month, you did 1 this month, this is great, right? But if you normally do 10 a month and now you're doing 1, that's not so great. So you got to be careful with these surveys because, again, it's current sentiment. It's how do you feel about activity? And these are just kind of phone surveys. So again, this is why we get some of this disparate data because of the way these things are calculated and how these responses are measured and weighed and the mathematical seasonal adjustments, all these things can cause problems. But that's that's the data we have, right? And this is why it's so important that we separate how we feel versus the data. Lots of debate about inflation, the economy, all this. Again, there's the real world experience of the economy. And again, we see this in talking to people, listening to people. What they say is like, oh, the economy's terrible. Costs are too high. Inflation's too high. It's just, I can't make ends meet. That's the real world experience. The economic data that we get from the government says something else. And so there's this natural tendency to push back against the government data because we're not experiencing what the government data says. That's okay. There's nothing wrong with that. But when it comes to investing, what you feel doesn't matter. What matters to investing into the markets is what the government data says. So it's important from your investing standpoint to separate out how you feel versus the government data. Because that's what the markets respond to, right? The market doesn't respond. And again, inflation's the easy one to pick on because there's such a dichotomy between what the government inflation says and what personal experiences of inflation are. And this is why there's so much anger towards that data when it comes out. It's like, inflation was down this month. Oh, BS, right? Have you been to the store lately? Have you bought groceries? Have you bought gas? Right? Those type of things. So it's natural to have that bit of vitriol towards the government data. But again, what the market cares about is the government data. That's what the markets respond to. So as investors, it's very important that we segregate out how we feel personally about the data, right? I just lost my job. The economy sucks. Job growth, very strong. Government data, it's all fixed, right? Doesn't matter. Your personal experience and the real world experience can be two very, very different things. And so as investors, we just have to simply focus on what the data says. Whether we agree with it or not is not important. We just have to focus on that and then measure our investments accordingly. And again, and then measure the risk. So how much risk are you taking, to garner that performance? And again, if you go back to taking a look at, for instance, XLK just did a rebalance. So 40% of that index is now two stocks. Marie in our chat was talking about VGT, which is the Vanguard Technology ETF. Very similar. Nearly 50% of that index is three stocks. So you're betting a big chunk of money on three stocks. And that's okay, right? Nothing wrong with that. But just realize the risk that you're taking on. If all of a sudden there is a reversal in one or two of those stocks, you're going to have problems. Your portfolio is going to decline much faster than the rest of the market because you're taking on a concentrated level of risk. And see, that's always fun when the markets are going up because we're making a lot of money. It's like, oh, this is awesome. And it just goes up every day. I'm just making money. I'm just printing money. I'm like my own Federal Reserve. Just printing money. And that's all fine until the printer shuts off. And it happens very quickly. So this is why you've got to measure risk, how much risk you're taking in your portfolio and manage that risk accordingly. So again, sometimes you're going to be too early. Sometimes you're going to be too late. That happens. That's just part of investing. So you got to be willing to take that risk and then you make adjustments. But again, just, be careful with this economic data and how you feel. Again, we talked about sentiment. We talked a lot previously about psychological behavior fallacies that we have as investors. I have them. Anybody that's literally human has psychological fallacies that we deal with when we're investing. We make mistakes. Nobody's perfect. But we have to just adjust for those mistakes. If we make a mistake, we go, yep, we made a mistake. we either get back into the stock, get out of the stock, whatever it is, right? Just, be unemotional. The one of the biggest things that we do to ourselves is we get very greedy on the way up. And then when we start getting into the correction, we won't sell because we keep hoping it's going to go back up again, because then we can sell at a higher level and then we'll get out, and then it keeps going lower. And then we get ourselves into the trap of, okay, well, when it comes back, I'll sell it. And then it keeps going lower. And that's where you're officially in the trap. And that's where you wind up losing a lot of money. And that's the thing we have to avoid when investing, is all those emotional biases that we have. Okay, so, all right, enough of that. Really this week, we're pretty light on data. We've got the Conference Board Consumer Confidence Index on Tuesday. Really, through the end of the month, or through Wednesday, not a lot of data. Now, on Thursday and Friday, we have first quarter GDP. This is the third estimate of the first quarter's GDP. So we're at 1.3%. That's expected to be revised up to 1.4% for the third estimate. We'll see. Durable goods orders on Thursday as well. And then Friday is PCE inflation. So that's the personal consumption expenditure index. That's inflation. That month over month is expected to be 0 versus 0.3%. So this is what I was talking about. And PCE, there's a couple of versions of PCE. The trimmed mean is average. So the trimmed mean PCE is what the Fed looks at for inflation. They don't really, yes, they look at CPI. Yes, they look at, PMI. But what they really look at in terms of their monetary policy is the trimmed mean PCE, which we'll get on Friday. That's expected to come down. And again, this is, exactly what I'm talking about, is that on Friday, if that number comes in at 0 or a negative 0.1, then everybody's like, BS. These people don't go to the grocery store, obviously, right? Doesn't matter. Markets are going to respond to that data. If it's too hot, if it comes in at 0.1 or 0.2, markets are going to sell off. Bond yields are going to go up, because that'll just simply be, the Fed's not going to cut rates. If it's 0 or negative, Fed's going to cut rates sooner. So markets go up, yields go down. That's, again, as we talked about before, that's where we are in this market, is it really has nothing to do with fundamentals anymore. It's just, what's the Fed going to do? Well, 2 sets of data on Thursday and Friday of this week as we wrap up the quarter. And also, this is the end of the quarter on Friday. So portfolio managers have to make sure that they're benchmarked to their indexes by Friday. So if they're underweight NVIDIA, underweight Microsoft, whatever it is, they're going to have to up that weighting in those shares. Or if they're overweight, they're going to have to cut it back. So again, you don't know how this is going to work out. But they've got to be balanced going into the end of the quarter, make sure they own the right stocks. So we could see a bit of volatility this week for sure. Important data on Thursday and Friday. We'll cover it here, of course, with you. If you have any questions, get by the website, realinvestmentadvice.com. Send me your questions, comments, emails. Make sure to subscribe to the weekly newsletter. We also got our blog posts that come out on Tuesday, Wednesday, Friday. So keep you up to date with all the information that you need to know managing your money. It's all at the website, realinvestmentadvice.com. Make sure to like and subscribe to the channel. We appreciate it very much. See you back here tomorrow.